On to this story now. Capitec Bank, the largest retail bank in South Africa based on client numbers, says it is tightening its lending criteria as more customers fall behind on their credit commitments. The bank released its financial performance for the year that ended in February, which saw the group's headline earnings increase by 15% to 9.7 billion rands. But the rise in impairments has largely been attributed for the 5% drop in the Capitec share price today since the announcement of the financial results. Profit from both the retail and business banks were up 12% and 124% respectively. Gerrie Fourie is the CEO at Capitec Bank and he joins us now. Gerrie, thank you very much for your time this afternoon. The past year has certainly been a difficult one for consumers, but when you look at what Capitec Bank has done, they've done well overall, with the return of shareholder equity stable at 26% from the previous year.
Yeah, I think we're quite happy with a 15% growth in our headline earnings. We've achieved, or we've got now 20 million clients that is active, and I think we've given back over 800 million to our clients, and we've invested 1.4 billion in future development or future opportunities. So I think if you look at that overall, I think it's a solid set of results. Everyone talks about the 80% increase in impairments. But, you know, it's the wrong thing to look at it year on year, because what we're sitting with is in 2020, our impairments was just over 4 billion. Then with COVID, it shot up to over 7 billion. And then we had a very abnormal low year last year of 3 billion and now 6 billion. So if you look at your impairments growth over a 4-year period, it's only 12%. And I think that gives you perspective. So I think one needs to be very careful when you look at the figures. It's like our operating expenses is down 5%, but you add in a very high OPEX base last year because of our empowerment scheme and bonuses that's been paid. So I think it's important that people look at it over a 4-year period to really understand the results.
Yes, indeed. And when you look at the consumers, they are still grappling with the impact and ramifications of COVID-19, as you've said. But as Capitec, you have deep insights into the financial well-being of at least 1 out of 3 people in South Africa. Consumers are actually applying for more credit because their finances have deteriorated in the past 2 years. You have shared exactly how much more consumers are spending on groceries and the like. Share with us those details when it comes to the increase in spend on various items and groceries when it comes to consumers.
Yeah, I think I want to go back to pre-COVID levels. If I look at interest rates now versus pre-COVID, we're only 1.5% higher. What happened with COVID is interest rates were dropped, and now in the last 2 years, it increased with 4.5%. So in perspective, interest rate is only 1.5% higher. If we look at inflation, pre-COVID was 5-6%, now it's 7%. Likely that it will probably drop very soon to 6%. So I think where the consumer has taken pressure, they got used to very low interest rates, spend the money, and now suddenly interest rates has gone up. I think if you compare pre-COVID with now, it's actually the unemployment rate was 24-25%, now it's 32%. So I think that's a little bit of perspective. But what we have seen in our 20 million clients is for sure that on the lending side, the 4.5% increase in interest rates is causing that people are repaying more. We've seen food inflation at 12%, 13%. We're seeing a spend of 8%, and I think that's a clear indication of people has actually bought down. Different goods have been bought. If I look at petrol, we see petrol going up, or spending on fuel, we see a 17% increase, and that you can expect given what has happened with fuel. Interesting, on home improvements, we've seen a drop of 12-13%. In COVID, people used to spend quite a lot of home improvements. Now they've cut back. So it's quite interesting to look at the different spends. I think the important point, and that's what you're highlighting, with 20 million clients, we understand the patterns, we see interesting patterns, and we can adjust and make certain that we can add value to clients in that perspective.
Gerrie, before I let you go, something really important, a step that you have taken, your tightening of the lending criteria is said to be 3 times more tighter than the National Credit Regulator. What exactly are you changing in terms of some of the things that you can tell us in terms of the lending criteria, which is obviously something that you've had to deal with resultant consumers having been under strain to repay most of their commitments?
No, I think just to correct in what you were saying is that the NCR allows a certain amount of living expenses that you must deduct when you do an affordability calculation. What we're saying is we 3.25% stricter than what the National Credit Act is allowing. So just to put your first bit into perspective. But we have tightened our credit policy, and I think all credit providers has given in the last couple of months has tightened, given the massive amount of people that's applying for credit and seeing credit as a short-term solution to go to solve their problems. I think it's more a question that consumers must start living within their means and make certain they've got financial discipline. That is ultimately the solution for people.
Gerrie Fourie is the CEO at Capitec Bank. Gerrie, thank you very much for your time this afternoon, telling us that the bank, of course, has had to do like most financial services, banks and others, in tightening the lending criteria to make sure that consumers can afford what they take out when it comes to the credit and other loans, as many consumers are actually using credit and other applications to supplement their income in these hard times.